Taxes can be one of the biggest drags on a portfolio's performance, yet many investors pay more than they need to every single year, and they might not even know it. In this episode, a tax pro explains some of the common mistakes he sees investors make and what they can do to fix them. You're watching Inside Investing. Hello, everyone, and welcome to the Inside Investing Show, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host here in Amin. Joining us is Neal Winokur, author of The Grumpy Accountant, perhaps one of the only accountants to make Canadian taxes somewhat less convoluted and interesting. Neal, thanks for taking the time to chat, and great to have you here with us.
Thanks so much for having me. Great to be here.
Neal, let's start at the obvious place over here, your book. Where did the moniker The Grumpy Accountant come from?
I remember once I was at a family dinner and I was complaining with everything that I thought was wrong with, well, really just everything. And then someone at the dinner said, "You sound like a grumpy old man." And I'm like, "Oh, grumpy, that's a funny word." And when I started to write the book, that was just the obvious title, like The Grumpy Accountant. And I remember reading The Wealthy Barber and Dave Chilton, who wrote that book. He has a whole course for book writers, self-publishers, and he says when you write a book, it should that's a very catchy kind of style of a title. The adjective noun. So The Wealthy Barber, The Grumpy Accountant.
Wanted to ask you then on that note as well, what inspired you to write the book about complexities of Canadian tax system?
After a number of years of practicing as a tax accountant in Canada, and really the focus of my practice at that time was just helping individuals and small business owners file their tax returns. What should be simple, right? But it wasn't, and people had to hire people like me to do it. And I started to realize all the problems with our tax system. And then I started to write down stories that were happening to me. Like I would just make notes, stories that were happening to my clients that I just thought were so ridiculous. And I started to blog and write articles and send it out to my client list, my newsletter. I realized like every day there's another story, and I just realized, wow, there's a lot of material here. Like this could be a whole book, and that's when it clicked in my head, oh, maybe I should write a book. And, I didn't realize how much work that would be. Like looking back, I would never do it again unless I had unless I had nothing else to do. Like if I won the lottery and I didn't have to work, okay, then I would write a book.
And it might I add, like you went from an accounting profession to a writer, which is it's not an easy jump to make that. So kudos for doing that. All right. So before we get into our conversation, just a quick note to our viewers. We're going to chat through some general tax strategies and considerations. That said, each investor's tax situation is unique. So take our discussion as food for thought rather than financial advice that's broadly applicable. Consider speaking with a tax professional if you have questions or concerns about your own circumstances. With that said, let's get right into it. All right, Neal, we're talking about the 5 tax mistakes here. We're going to start with our first one on your list, and that is when investors don't adjust the taxes that come out of their paycheck. How might this hold back an investment plan?
Well, one of the key rules in investing obviously is time value of money, right? And starting early. So the earlier you start investing, in terms of your timeline, because of compounding, I'm sure everyone listening is aware of how compounding works, right? You want to start investing whatever you have to invest as early as humanly possible. So the problem with people who receive a large tax refund every year, and there's articles about this, like at this time of year, April, you were loaning money to the government of Canada interest-free for a year, and now they're just giving it back to you because they should never have taken it off your paycheck. Why are you getting a big refund? Because every paycheck you receive, income tax is being deducted. But if they're deducting too much, because you have all sorts of deductions and credits to claim when you file your tax return, so you're going to get it back at the end of the year when you file your tax return for last year. But imagine if you had that money with each paycheck. Imagine if your paycheck, your deposit if you get direct deposit or you get a check, it could be higher every 2 weeks or every month or, twice a month whenever you get paid. You could have less tax deducted from each paycheck. And a lot of people don't understand that. You could increase your paycheck every check. There's just a form you file to CRA at the start of every year. And it's basically just a request. You request to the CRA, hey, CRA, please can I keep more of my money during the year? And here's why. Here's the deduction or credit that I claim every year. And they just approve it. And then that is then, given to your employer, and then they will deduct less tax from each paycheck.
And let me ask you this: when I always go with a bit of trepidation when I have to fill out extra forms when it comes to taxes. Does this require some sort of specialized knowledge to get it done, or in other words, do I need a grumpy accountant, or can I just fill it out myself and give it off to my employer?
I think this is the form that you could fill out yourself, fill in your information, your name, your SIN number, all of that. And then the deduction or credit that is causing you to receive that large tax refund every year. And then your employer will deduct less pay from each check. It's very simple. Unfortunately, you have to do it at the start of every year. A similar issue comes up when people if you start a new job, whether at the start of the year or the middle of the year, people change jobs. Your employer, whenever you start a new job and when your employer puts you on payroll, there's it's called a TD1 form, and there's a form for the province as well, where if you are entitled to certain large deductions or credits, you can indicate that on that form, and then your employer will then calculate how much income tax should be deducted from your pay based on that. So that's another opportunity to do that as well when you start a new job.
You can fill it up front and yeah, get them to just credit you, right? Because you know some of those predictable costs that you're going to have throughout the year that do give you credit. So yeah, that's good. And I like the point that you brought up, which was the compounding effect, which we really want to focus on for our viewers. Is it's in the finance world, I think they regard it as what, like the eighth wonder of the finance world. Money received now is always going to be money better than money received later. And as long as you put it to good use, if you're doing these deductions or sort of reducing the taxes on your paycheck and putting it towards your RSPs, of course, you wanted to put it towards a good cause such as that. So great point you raised that up. All right, let's move on to our second tax mistake that makes it on your list, and that is when investors mistakenly overcontribute their registered accounts. Now, this seems a relatively easy mistake to avoid, but why is it so prevalent in your experience?
It's so prevalent. This is happening now a lot with TFSAs.
Hmm.
RSPs also, but not as much with the RSP, but with TFSAs, TFSAs were only created in 2009. It's interesting how time flies because that's already 15 years ago. People just don't understand the rules. They log into their CRA account, or they see their contribution room on their notice of assessment from the CRA, and it's wrong. You can't rely on that. It's such a crazy system. The CRA's system. If you log into your CRA My Account online and you see your TFSA contribution room, I advise people don't rely on that number. First of all, it could be 1 year out of date because it doesn't have like the previous calendar year's information. It might not be there yet. It might not be up to date. So, and second of all, if you are a non-resident of Canada for a number of years and the CRA doesn't know that, they're going to give you that contribution room, but really you weren't entitled to it. Or maybe it just has your wrong date of birth in its system, so it's giving you years you shouldn't have had the contribution before. Um, Also, a lot of people think, if they withdraw money from their TFSA, they think they can just put it right back in the next day. That might not be the case. You might have to wait until the next January 1st if you've already maxed out your contribution room in that year. You can't just recontribute it. You have to wait till the next calendar year to get back the room. There's all these weird rules.
Let me ask you then a follow up to this. So, if you've seen this happen quite often as an investor, what happens when we overcontribute to a registered account?
There's penalties and interest. The CRA will send you an assessment of these penalties and interest. Um, the first thing you should do is withdraw the overcontribution right away, if you can. Hopefully you can. Some people invest the money, they lose it all, and now they can't withdraw it, and the penalties and interest add up. It's crazy. So it's very important. Like I always advise clients to keep track of your TFSA contribution room on some sort of Excel spreadsheet or a Google sheet or whatever you like to use, where you keep track of it yourself every year. Here are my contributions. Here are my withdrawals. Every year you get new contribution rooms. So add that in, right? And keep track of it yourself, because the CRA's online system or their notice of assessment, it's always like a year behind.
Let's go back to the overcontribution point, because where it can become sticky, as you mentioned, you kind of mentioned about being a non-resident of Canada, or someone who might be a dual citizen of Canada, and they might stay for extended periods abroad. What does that mean for them?
Let's say you leave Canada and you declare yourself to CRA as a non-resident for 1 year, 3 year, 5 years, 10 years, whatever. All of those years that you're a non-resident for tax purposes, you don't generate the TFSA contribution room every year. So let's say you return to Canada 10 years later and you think that, oh, the past 10 years, let's just use a round number, the TFSA contribution was $6,000 each year. Now I have a new $60,000 of TFSA contribution. No, you don't. And I've seen this happen, right? Because maybe people fail or neglect to tell the CRA that and declare themselves as non-residents. So they didn't file a tax return for 10 years. Okay. And then they come back to Canada and then they contribute to their TFSA thinking that they have those 10 years of contribution room. And then the CRA says, oh, and then the CRA sends them a letter, hey, you didn't file tax returns for these 10 years. Please file them. And then you're like, oh, I wasn't a resident of Canada. Then the next thing that happens, the CRA sends them a letter saying, and then as an assessment, oh, you over-contributed to your TFSA by $60,000, and here's a $20,000 penalty. So these are the kinds of things that happen. The other thing that I should mention is kind of the opposite for U.S. citizens who are in Canada. This is a big issue. There's a lot of dual citizens who are Canadians. They might never have even lived in the U.S. for a day in their life. They live in Canada, but they're U.S. citizens. They have to file U.S. tax returns. So in theory, so they actually look at the TFSA, not like RRSP. You don't have to worry about an RSP if you're a U.S. citizen in Canada, but the TFSA, any income earned in the TFSA, you actually have to pay tax on in the U.S. because they don't consider it like a retirement account. So I think a lot of Canadian tax advisors are advising their clients who are U.S. citizens, don't even bother opening a TFSA. It might not be worth it. Same thing with RESP for your kids. People will usually advise U.S. citizens don't have an RESP, or if you're married to a non-U.S. citizen, put the RESP in that spouse's name and keep your name off of it. So there's all these kinds of things that can come up if you're a dual citizen. So you should those people should get more specialized tax advice from an accountant who specializes in the country that they might be a dual citizen of.
Yeah, and this is a perfect conversation you brought this up, because my wife happens to be a U.S. citizen, so I kind of learned about all of this as I was going through it and filing taxes, knowing that they don't recognize the TFSA, right. RSPs, you have to keep individual names. So I'm glad and that might be applicable to a lot of our viewers who do have that dual citizenship. We talked about TFSA a moment ago, but what happens to the RSP and specifically to the contribution room if we're a non-resident there? Do we still accumulate it if we're getting like income from somewhere else, or does that stop as well?
Like, let's say you move to, I don't know, let's say you move to Italy and you have a job in Italy. You don't have to file a Canadian tax return once you're a non-resident of Canada, right? So I don't see how you would get RSP contribution room based on your income from another country. Passive investment income, like dividends, interest, capital gains, that does not generate RSP contribution room. It has to be considered earned income that generates the RSP contribution room.
All right, so before we continue, I have a quick question for our audience. Are you enjoying the show so far? Then subscribe to TD Direct Investing on YouTube so you don't miss an episode of Inside Investing. Plus, let us know what you want to learn more about so we can best help you in your investing journey. All right, let's bring the conversation back, Neal. Speaking of RRSPs, that brings us to the third tax mistake on your list, and that is letting an RRSP grow too large. Now, having a large RRSP might sound like a great problem to have. So what's the potential downside here?
Right. So this is a really interesting question. What happens with RRSPs in the year after you turn 71 years old? There are forced withdrawals from the RRSP. The RRSP converts into what they call a RIF, RRIF, Registered Retirement Income Fund, or you can convert your RRSP into what's called an annuity, which will then kind of pay you out annually. But so there's different things you can do. But either way, basically, after you turn 71, the money starts coming out into your personal income tax. You can choose to withdraw earlier, by the way, but after you turn 71, it comes out no matter what at certain percentages every year. But the big issue is if you have too much in your RSP on the date of death, then what happens is whatever you have left in your RSP on the date of death is just included in your what's called the final tax return. So let's say you have $500,000 left in there. You're now going to have an extra $500,000 of income in your final tax return. So it's going to push you into the highest tax bracket. Now you're effectively paying 50% income tax. So that's why a lot of people are afraid of the RSP. But even with that tax hit, it might still have been worth it all those years. You might still come out ahead if you really do all the math. So, but it's a very interesting question. And like ideally, you don't want to have that huge, gigantic value in your RSP by that date of death in an ideal world.
CPP, OAS, does this impact any of those amounts that you're going to get in retirement if you have this large RRSP?
Everything impacts together because all your taxable income from all different sources is added together, and it could push you into higher tax brackets. So if you know you're getting CPP and maybe you have a pension from your work, or maybe you don't, but maybe you have other income, and you're going to have RSP withdrawals starting at 71, you have to add all this together. As your income goes up in retirement, you get into higher tax brackets, you lose out on credits and things you might have been entitled to. So you want to try to plan for this. It's all interconnected. Right. It's not a simple, black or white answer, right? It really depends on the particular situation.
Yeah, everyone's situation is unique, and that's the beauty of this thing. Like, you really do want to get that retirement planning or estate planning, as you mentioned, to just assess everyone's circumstances there. Now, let me ask you this. In your opinion, I'm going to ask you to quantify this. At what point does an RRSP generally become too big and start causing tax issues for retirees? So in your experience, what would you say to that?
I don't know if I can answer that with a specific number, right? But if you Google, for example, if you go on Google and just type in, 2024 Canadian income tax brackets, right? You could see, and there's tax calculators, like you can calculate, like you can say, okay, I know I have $50,000 of other income. Okay, what happens? How much tax will I pay if I want to withdraw $80,000 from my RSP today, right? So you could go on the tax calculator, put in $50,000 of income, see how much tax is payable, right? Write down that number. Now add in $100,000 of other income, see how much tax is payable. Now you can calculate the difference and see the tax hit and calculate the actual percentage, like that effective tax rate, right? I just want to mention with CPP and OAS, you can actually go on the Service Canada website and you could set up your My Service Canada account. And then you can actually see right in there how much CPP you will be entitled to based on all the contributions you've made for all your working years, right? So that's just something to take into account in terms of your planning. You could get that information.
Yeah, and I know you mentioned the calculators. I think the CRA has some great, fantastic ones as well about OAS and things like that, where you can kind of figure out what those might be and if there's going to be clawbacks depending on the large withdrawals you may have to deal with the RSPs. So what can a retiree consider doing to help manage the size of their RRSP and prevent it from growing too large?
The forced withdrawals start happening in the year after you turn 71 years old, but there's nothing stopping you from withdrawing earlier and starting to draw down on it. You could withdraw RSP at any time. Like even if you're 25 years old and you have money in RSP, you could withdraw, right? There's no restriction. Yeah. You have to pay tax on it. It gets included in your income. And depending on what other income you have, you might owe tax on the withdrawal. So for example, let's say you turn 55 or 60, and let's say you start slowing down, earning less income for whatever reason. Maybe you're in the lower tax brackets for whatever reason. You could do you can just withdraw early every year, right? From your 60 until 70, let's say. And then the flip side could be delay CPP until you turn 70. If some people don't like doing that. People just want to take it at 65, but then it pushes you into a higher tax bracket from 65 to 70. But if you, for some reason, are very confident you're going to live very long, delay CPP until 70, and then from 65 to 70, start taking out of your RSP, right? So that's like a strategy that some people might do. Again, I'm not advising that. I'm just saying that could be something you can write down as a potential strategy and ask your advisor Is that, could that be a good idea potentially?
Now, another potential solution would be to use a spousal RRSP. Can you fill us in on how it works and why it might help bring a tax bill down?
If there's a situation where a married couple, one spouse is in a high income tax bracket and the other spouse has zero income or is in a lower income tax bracket, the higher income spouse contributes into the lower income spouse's RSP. The higher income spouse gets the nice big deduction on their tax return. So they get a nice big tax refund. And then the lower income spouse, they can withdraw it into their income. It'll go into their income tax return as income, but they're in a lower income tax bracket. So they might not pay any tax on it at all, or maybe a very low rate, right? Effectively. So this is a very powerful tool that people should be considering. If you know that's going to be your situation later on for whatever reason, this is a great tool that can be planned to help smooth out, like to make sure you're both in a similar bracket, or at least move income from the higher income spouse to the lower income spouse, which will save on the overall family tax bill. It's just a great opportunity. If you know one spouse might not be working for a few years, let's say you're having kids and there's little kids at home and one spouse decides to stay home. So again, there could be opportunities.
You do open the spousal RSP. Does it then impact let's say the lower tax bracket spouse? Let's say they have earned income. Does it impact their RSP room at all?
No, this is based on the higher income spouse's contribution room, right? So the lower income spouse's contribution room is still calculated every year based on their income, like whatever their employment or self-employment earned income is.
That makes sense. Yeah, and then that's why usually you see them as two separate sort of distinct accounts when they get set up.
Right.
All right, let's go on to our fourth tax mistake, and this is one you focus on a lot in your accounting practice. It's when self-employed investors don't invest excess profits through their corporation. So can you walk us through this, why this might be beneficial for some entrepreneurs?
Yeah, so anyone who has their own business in Canada, this is the number one question we get. Should I incorporate or not incorporate my business? Because you can operate just as what's called a sole proprietor. And sole proprietor or self-employed individual, that just means your business income and expenses will be recorded on your personal income tax return, and whatever net income is there or net loss will be included with any other sources of income you have, rental income, employment income, and it's really just your personal. It's not really separate from you individually. You pay personal income tax on the net income of your small business, your sole proprietorship. The reason why people like to incorporate a separate corporation, I always tell people it's like having a baby. It's like a separate legal entity. The corporation is separate from you. It'll have its own bank account, its own CRA business number, files its own corporate tax return. So all the money that the corporation earns, the profit, the first $500,000 of profit, is the income tax on that is only 12.2%. And that's the Ontario tax rate. Combined federal plus Ontario, 12.2% right now on the first $500,000 of active business income. Okay, so that's really advantageous. Like the general rule of thumb, what we tell entrepreneurs is if you're going to make more money, profit after expenses, if your profit after your business expenses will be more than what you need to live off of personally, like to pay all your personal living expenses, then you might want to consider incorporating. Let's say your living expenses are, I don't know, $80,000 a year, and you're making $150,000 a year of profit. So you can leave $70,000 every year in the corporation and be taxed at 12.2% instead of the higher personal tax rates, which in that bracket could be 35% or 30, 35, 40, right? So there's definitely an advantage. And what people don't realize is that in your corporation, you could actually open an investment account and have investments, stocks and bonds, and you can earn dividends and interest and capital gains. Then you'll still pay high rates of income tax on that investment income every year, but you'll have more principal to invest in the first place. You'll have more because you only pay 12.2% tax on the profit instead of personally 35, 40, 45, 50, 53% tax. So it's almost like having another RRSP but it's much more flexible because you can take money out of the corporation at any time you want. There's no forced withdrawals, right? So you will eventually pay the personal income tax when you take the money out of your corporation. And the investment income in the corporation will be taxed every year, but you have so much more money to invest now. And even above 500,000, the tax rate's 26 or
Okay.
26.5%, something like that, which is still lower than the personal rates.
But one of the beauties of this is capital gains inclusion rate doesn't change from personal to corporation. It's still the 50% of what you're making. And that 50% that you get taxed, again, if it remains in the corporation, you're saying it's only 12.2%?
No, no. So the investment income is
Hmm.
taxed at higher rates. The
Okay.
12.2% is only on your actual business income
On the
from
earned
the
business
actual
income.
business.
Okay.
You're basically taxed half of half. So it's effectively 25% flat rate on the capital gain. Dividends are taxed favorably in the corporation because you still get that dividend tax credit. The interesting thing about investment income earned in the corporation is that it generates what's called refundable dividend tax. So if you pay out a dividend from the corporation to yourself personally, the corporation will get effectively like some of that tax back that it paid on the investment income or that it would otherwise owe. It would effectively be offset by paying a dividend to yourself personally. So it gets very complicated. You have to have a good
Sure.
tax advisor when you have these corporations. But people should just know that there is potentially a big advantage here to
Of
doing
doing
this
that.
kind of thing.
Of course, absolutely. So let's talk about that a bit more. So, how could an entrepreneur figure out if investing through a corporate account might make sense for their situation?
There's a few things you have to know. Number one, what are your personal living expenses every year? What's your budget? Like, how much do you need from your corporation to pay yourself personally to be able to fund your personal living expenses? That's question number one. Question number two is, what about RSPs and TFSAs? That still might make more sense than the corporation if they're not maxed out yet. Maybe we want to max those out first. But let's say we've dealt with that. Let's say those are maxed out. Okay, now let's run some numbers. How much extra profit do you have to invest every year? What are you going to invest it in? That will also affect it. The taxation of interest, capital gains, dividends is different for each one. So it gets pretty complicated.
Okay, but it's a good place for people to start thinking about these things, of course. So
Yes.
that's something to good considerations to have. Let's round off our fifth tax mistake here, Neil. That's on your list, and that's when investors wait too long to gift investment money to their family. Why might this be a problem, and what can an investor do to help avoid it?
If you gift money during your lifetime, the recipient gets that totally tax free. Like there's no, right? So if you have just cash sitting in an account and you're living in a province with like a high estate tax, that might not make a lot of sense in theory, right? It just depends on your situation. Maybe you have a grandchild that's now 19 years old and you want to help them out, you're feeling generous. You could just give them money, they could contribute to their TFSA, and there's no tax consequence. I mean, the only tax consequence would be if your money is sitting in investments, you have to sell, and then you
Right.
realize a capital gain. Okay, so now there's tax. I mean, this is like leads to like awkward conversations between family members, and but just from a purely numbers perspective, there could be some tax savings here, right? On terms of an overall family kind of generational planning, right? It should be part of the discussion in terms of estate planning. Do you want to start getting rid of some assets and funds during your lifetime in a tax effective way, right?
Let me touch on one thing then with this. So we talk about gifting and monetary, we know that, but let's say you can do a gift in kind. Like so if you say stock is what we talked about, like could I give stock to, family member? And would that relieve me of any tax obligation? Because I'm technically not selling it, but if I'm giving it in kind, would that take the burden off?
Not really. It's still considered sold at the fair market value. So you might like, and same thing with, let's say, a house. Like some people think, oh, I'll just sell my house for $1 to my adult child. It's not really how it works. It's deemed sold at fair market value. You can transfer the stocks in kind to a
Right.
different person, a different investment account, but you'll still have to report effectively as if the stock was sold in your tax return in that year.
Um, all right, Neil. So that was a fantastic. We went through the list here, so fantastic. We're covered off here. Just wanted to give a quick reminder to our viewers: if you want to learn more about common tax mistakes that investors make, check out our past episode with Nicole Ewing from TD Wealth. It's called Five Tax Mistakes to Avoid in RRSPs and TFSAs, and it's available in the Learning Center on Web Broker and on TD's YouTube page. All right, we're going to leave it there, Neal. Thanks for sharing some of the ways that investors can avoid tax mistakes you see them make. I'm sure you've given our viewers a lot to think about come tax time, of course. And any final thoughts you'd like to share with our viewers?
I think the main thing is whenever you have these kinds of questions, people always go on Google and then they think they get the right answer and they're dealing with like a website from the UK or the US or Australia or France, and they don't understand that you need to get advice from a tax expert in the area that you need advice on, and don't rely on Google or anything you read online. Even the CRA website I wouldn't rely on because it could be out of date, and you can ask 3 different people at the CRA and get 3 different answers if you call CRA. Just really try to find people in your network, ask around for trusted advisors. I think that's the most important thing.
Absolutely. Okay, so I'm going to keep a Rolodex of some grumpy accountants then, Neal, and we'll make sure to look them up. So once again, thanks for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time.
Have more questions? Check out the links to the right and in the description below.